Welcome back to our journey through the market matrix. In our previous video, we explored how the market operates as a game within a game and how market psychology drives price action. Today, we're connecting these concepts by revealing how technical patterns are actually the visible footprints of mass psychology. Most traders approach technical analysis as if chart patterns are some kind of mystical divination tool. They memorize patterns without understanding what these patterns actually represent. But when you grasp that every line on a chart is simply the aggregate behavior of human beings making emotional decisions, technical analysis takes on an entirely new dimension. Let's start with the most basic and powerful pattern, the trend. A trend isn't just a line on a chart, it's a visual representation of collective human consensus. An uptrend shows growing optimism and confidence. A downtrend reveals spreading fear and pessimism. The slope of the trend line, that's the rate at which this emotional consensus is building. When you understand that reality, you realize that the trend is your friend isn't just a catchy phrase. It's a recognition that fighting against collective human psychology is usually a losing battle. But trends don't move in straight lines because human emotion doesn't progress linearly. This brings us to pullbacks and consolidations, periods where conviction temporarily wanes and uncertainty rises. These patterns reveal the natural rhythm and human psychology, periods of conviction followed by doubt, followed by renewed conviction. Next, let's examine support and resistance from a psychological perspective. Support isn't just a line where buying happens. It's a price level where collective memory creates a shared belief that something is cheap. Resistance is the price where collective memory creates a shared belief that something is expensive. This explains why previous highs and lows become significant. They're price points embedded in the market's collective consciousness. They represent emotional extremes that participants remember and react to. Now let's look at some specific patterns and decode their psychological significance. Double tops and double bottoms are among the most reliable reversal patterns. Psychologically, they represent a market testing its conviction. In a double top, buyers make a second attempt to push prices higher but fail, revealing waning bullish conviction. This failure becomes a self-fulfilling prophecy as participants recognize the pattern and act on it. Head and shoulders patterns show the transition from optimism to realism to pessimism. The left shoulder forms as enthusiasm drives prices up. The head forms as smart money starts distributing their positions to eager buyers. The right shoulder forms as the last buyers enter before the selling pressure becomes overwhelming. The neckline break happens when collective recognition of the pattern triggers mass selling. Gaps in price action are pure emotional reactions, moments where overnight news or events cause such a shift in perception that prices must jump to find equilibrium. Gaps show times when emotion temporarily overwhelms orderly price discovery. Wedges and triangles reveal the tension between competing psychological forces. As these patterns tighten, they show diminishing volatility and growing anticipation. The eventual breakout occurs when one psychological force finally overwhelms the other. Let me share how understanding the psychology behind these patterns has helped me capture profits throughout my trading career. When I identify chart patterns, I'm not just seeing shapes, I'm reading the psychological story. For example, when cup and handle formations, most traders simply see a bullish continuation pattern. But understanding the psychology reveals much more. The cup represents a gradual return of confidence after a sell-off. The handle shows a final period of doubt where weak hands are shaken out before the next advance. By recognizing this psychological process, I can enter near the end of the handle formation with higher conviction, while others remain uncertain. This psychological edge often allows me to position before major moves with better risk-to-reward ratios. But the most powerful application comes when you combine pattern recognition with volume analysis. Volume is the intensity of conviction behind price movement. When a technical pattern forms with confirming volume, it tells you the psychological shift is backed by serious commitment. For example, a breakout on high volume shows strong conviction in the new direction. A breakdown on low volume might just be a lack of buyers rather than aggressive selling, a crucial distinction. Here's how you can start trading the psychology behind patterns rather than just the patterns themselves. First, stop thinking of technical analysis as a mechanical system of buy and sell signals. Start seeing it as a window into mass psychology. Ask yourself, what emotion is this pattern revealing? Second, pay attention to the context. The same pattern means different things in different market environments. A double bottom during a market-wide fear is more significant than one during general complacency. Third, use multiple time frames to understand the psychological narrative. The daily chart might show a breakdown, but the weekly chart should reveal this as just a pullback in a larger uptrend. Fourth, combine pattern analysis with sentiment indicators. When technical patterns align with extremes in sentiment measures like the put-call ratio or the VIX, the signals become much stronger. Finally, use psychological understanding to manage your own emotions. When you recognize that a falling knife pattern represents pure panic, you can prepare yourself mentally to be a contrarian buyer when others are selling in fear. Remember, in the game within a game, technical patterns aren't magical signals. They're the visible manifestation of human psychology playing out on a mass scale. The traders who understand this don't just see lines on a chart. They see the ebbs and flows of fear, greed, doubt, and conviction. In our next video, we'll explore risk management through this same psychological lens, how understanding your own emotional responses to the market can help you preserve capital and maximize returns. Until then, start looking deeper than the patterns themselves. See the human emotions behind the lines. Because in the market, psychology isn't just a factor. It's the only factor that ultimately matters.